Hi friends, Jim here from AFS. Today we're talking all about risk. Now we know that investing in the stock market historically has been a good way to build our wealth over time. But as you've probably heard me say many times before, there's a cost of admission to investing in the stock market, and that cost is risk. Listen very closely. Your account value will go down sometimes. That's part of the process, as strange as that may sound. Think about it like this. If your account value never went down, it would be like a savings account at your bank. Are you getting really great long-term returns from your bank account money? I didn't think so. No risk, no reward. So what are these different types of market risk? We're going to get into that. But first, what is market risk anyway? Well, market risk is the risk of seeing your account value go down, not because of anything specific to one company or sector or even a mutual fund, but because the entire stock market goes down in value. This risk affects the entire market, so it can't be avoided no matter how diversified your investments might be. Now that's not fun, but it's part of that cost of admission that we talked about before. So what types of market risk are out there? I'm going to go through some of the main ones so you can get a feel for what we're talking about. Interest rate risk. This one is more commonly associated with bonds rather than stocks, and the bond market can be pretty complex. But here's one little tidbit to impress your friends. Bond prices have an inverse relationship to interest rates, meaning that when interest rates go up, bond prices go down, and vice versa. Number 2, inflation risk. Inflation is the cost of goods rising over time. Think about how much you spent on your first cell phone or your first car compared to what you have now. Prices go up. So while keeping your money out of the stock market might make you feel safer, you could be taking on more risk than you think if you're not earning enough to keep up with the increased cost of goods or inflation. Number 3, currency risk. This is the possibility of losing your purchasing power due to changes in the exchange rate. If you've ever traveled abroad, you might have had to experience this exchange rate. Sometimes it hurts, sometimes it helps. Liquidity risk. Liquidity is the ability to sell something when you need money. If you own shares of a huge company like Amazon or Apple, for example, and you want to sell those shares, those stocks are traded so often that you almost never have trouble finding a buyer at a fair market price. But if you're an owner of a local business and you need to sell that for cash, it might take some time, or you might have to sell it for a lower price than it's worth if you need that money fast. That's liquidity risk. Socio-political and geopolitical. Now there are issues such as war, corruption, or geopolitical risk that is basically where geography, economics, and politics intersect. More broadly, it's about how well different countries of the world get along, or don't, and how a certain nation's economic or foreign policy might affect other countries. So what can you do to prepare for market risks? Well, part of the battle is just recognizing that risk will always be there, and most of it's out of your control. You have to know and understand that there will be tough times when your account value goes down, sometimes by a lot, but those are not times to panic. Instead, think about those as an opportunity to buy stuff when it's on sale. Consider writing your strategy down. Jot down a reminder that you know your account value will go down sometimes. It'll be tough, but you will not panic and you'll stick to the plan. This is going to give you a big advantage over your peers. You're going to have a better chance to build your wealth compared to others who might be making the wrong move at the wrong time. Well, that's all for now. For more on investing or anything else in your financial life, please check out MoneyNav. We hope to see you soon. Take care.